You have a weakening economy, you have persistent inflation. There's just so much bad stuff going on right now. To answer your question, do we think that this upward move in gold prices is going to end or not? The answer is...
I'm pleased to welcome back to the show Jeff Christian, managing partner of the CPM Group. Jeff, welcome back. It's been a hectic summer for you personally, I know. And we're good to have you back. It's been a hectic summer for the markets. And this is the focus of our conversation today, whether or not this hectic rally that gold has experienced in the last couple of weeks is here to stay with us. Welcome back to the show. Good to see you.
Thanks for having me back.
The central question, I'll just start with that. Is this gold rally here to stay? We've talked offline about your gold forecast that you've made, that you and the CPM Group have made earlier this year, your gold yearbook that comes out annually. Remind us one more time, please, what is the average gold price that you're expecting for the end of the year? And basically, is this rally lining up or exceeding your initial forecast?
Well, our average forecast for gold for this year has been about $4,450. Our expectation was that the gold price would be in the 4,800 to 5,000 range by the end of this year. So our expectation has been that the gold price would be rising from the end of August into the end of 2026. We probably will be increasing that average price projection. I think that will probably hold where we think the price will be at the end of the year to that $4,800 to $5,000 range. Could be a little higher, but we'll probably be increasing our annual average projection from 4,450 because the price is already higher than we thought it would be in August, and we're seeing upward pressure on the price. To answer your question, do we think that this upward move in gold prices is going to end or not? The answer is we think that there could be a pullback in early September, but our expectation, as I just said, is that the gold price is going to rise from now into the end of the year, if not into 2027. And that's based on our reading of the economic and financial and political world.
Several financial institutions, including the Bank of America, earlier this year lowered their gold price forecast for the year after the Iran war began and interest rates started to rise. Recall that the long end of the Treasury yield curve has been rising for several months now. This all changed, following a few events. July 31st, was the first day that gold started rising from $4,000. That was when the Treasury intervened in the yen market, buying yens to prop up the Japanese yen. The theory is that if the yen carry trade unwinds, then there could be a sell-off in U.S. Treasuries, pushing up yields. The second event was just last week on August 19th, when the Treasury announced that they would double their bond buyback program from $2 to $4 billion per operation. Just this week, right. As a reminder to the audience, the Treasury announced that they could use their Treasury general account. Scott Besson said on CNBC, they have up to $1 trillion at their disposal. Anyway, the point is the gold markets and sentiment overall turned once the Treasury started intervening in the yield market. Do you believe that A, this intervention will work and that yields will eventually be brought down, or at least we're capping it at around this current level? And B, if it does work, would you be raising your gold price forecast given that yields are no longer a concern for gold?
Well, first off, the intervention for the yen, if that's what you're talking about, we don't think that ultimately is a positive. And for the Japanese yen or the Japanese economy or the world economy, those kinds of interventions don't work. And they were largely discredited by the early 1980s, and most central banks stopped trying to intervene to support their currencies by buying those currencies. And you started to see, the general consensus learned in the 70s and early 80s was that central bank interventions can accelerate directions in currency markets, but they can't necessarily reverse the direction. So if you see the yen under pressure, the idea of buying yen to push the yen up probably is a bad idea because it probably won't work. So, we think that on the first, there are about 5 reasons why we think the yen intervention is bad. One is it won't work. The second is it signals to the economy and to the financial markets that central banks are going back to previously discredited policies. This is something that we learned 40 years ago, and yet the U.S. Treasury and the Bank of Japan are doing it. So that doesn't help create financial market confidence in monetary and financial and fiscal management. So, we think that all will help support investment demand for gold and silver because it's a failed idea. The second thing that you talked about, which was the Treasury doubling its bond buyback, that's a gigantic indication that even the Trump administration has realized the extent to which the economy is in trouble. You're pumping twice as much money into the economy. You're obviously very much concerned about economic weakness over the next few months going into the midterm election. So I think that the Treasury buying back and pumping extra currency into the U.S. economy is a sign that even the U.S. Treasury, which I don't have much respect for at present, understands that the U.S. economy is weakening. So you have a very interesting situation. You have a weakening economy, you have persistent inflation, and you have Treasury and the Fed that says, how do we deal with this? On the one hand, we'd like to lower interest rates to help the economy, but on the other hand, we have this persistent inflation, and other things that the administration are doing are contributing to that inflation. They've now suspended their beef tariffs, but they're making tariffs and they're making imports more expensive. They're making domestically produced goods more expensive. They're causing oil market disruptions. There's just so much bad stuff going on right now. You put that all together, and investors have been buying more gold and silver over the last week or two because they look at the fiscal management of the U.S. government and they say, this is problematic.
One thing I've noticed after interviewing so many investors, economists, and market analysts over the years is that experts rarely ask themselves, what should I buy in the very beginning of the investment making decision process? In fact, they actually begin the process with a different question altogether, which is, why would I own it? Before they allocate capital to any asset, they want to understand the role it plays in a portfolio, the trade-offs, and whether it aligns with their long-term goals. And I think that's a pretty thoughtful approach. So if you've been hearing more discussions about physical gold and silver, and you're wondering whether or not they fit into a long-term financial plan that's right for you, well, it's worth taking the time to understand how they work before making any investment decisions. And that's why I partner with Augusta. Today's sponsor, Augusta Precious Metals, has an experienced education team that offers personalized one-on-one educational web conferences where they'll explain the different ways people own physical gold and silver, including how purchasing precious metals is different from owning a gold IRA. They'll help answer your questions and help you understand your options better. Whether you ultimately decide precious metals are right for you is entirely your decision. So if you'd like to learn more, visit lintrustgold.com, link in the description down below, or scan the QR code here, or text LIN, L-I-N, to 35052 to request Augusta's free guide. Remember, the best investment decisions don't come until you start to understand why you should own something. So it's not a yield story, you don't think? It's not, gold isn't reacting to the signal that the 10-year and the 30-year aren't going up anymore?
No, I don't think that that's it. I think the interest rates are reacting to the same thing that gold and silver are reacting to, which is fiscal policy.
I see. Somebody asked me a question the other day, and that was a very good question. You're probably better at answering this than I am. Well, not probably, you are. So I'll ask you the same question. Do you think that the dollar is still the de facto safe haven asset during times of distress like this? All these events that you mentioned and
Yeah.
these scenarios that are popping up, the flight to safety asset, the de facto flight to safety asset, which is it right now?
It's gold in the dollar, and there are times when people lean on the dollar and they say, this is the safe haven asset I want to focus on. And there are times when they lean on gold. And there are times, and I think the present time is one of them, where they say it's gold and the dollar. So, and for gold, it's gold, and there are a lot of reasons to expect gold prices to rise. With the dollar, I don't necessarily think there's a tremendous amount of confidence that it's a long-term safe haven. But what it is it is the best of the worst in terms of sovereign debt. So when you start looking at the credit worthiness of people that you can loan money to, i.e., which sovereign credit do you want to accept? The US, for all of its problems, right now still probably is the one of the safest, if not the safest place to park your money. So I don't think that there's a lot of people who are enthusiastic, or central banks, or corporations, or pension funds that are enthusiastic about buying more treasuries, but they look at it and they say that's probably the best place to be for large volume parking of assets.
Some people might ask, how could it be both the gold and how can it be both the dollar and gold together? Aren't they? Isn't gold an anti-dollar asset? Aren't they the antithesis of each other? So here I'm just going to lay the chart on the screen here for you to look at while you answer this question. This is gold and the DXY, with the DXY being the blue line here.
Right. That's a common misperception. Gold doesn't trade against the dollar. The correlation of monthly changes in the dollar to monthly changes in gold prices is something like 38% or something like that. And you have periods of time when I say, yes, I said, there are times when people say, I want the dollar. There are times when they say, I want gold. And there are times when they say, I want the dollar and gold. This was the case in 1979, in the second half of 1979. And I had this guy that I worked with who was really, he was a believer, not a knower. And he kept saying the dollar and gold can't rise at the same time. And day in, day out, he would say that, and day in, day out, everybody else in the company would say, but they are, and that's where we are right now. So the idea that the dollar and gold can rise at the same time is not incongruous with reality. And it actually is very much indicative of the degree to which financial market participants around the world are worried about the state of the world economy and the stability of financial markets.
Right now, as you see it, do you see a scenario in which gold could retrace $4,000?
I think gold can go back to $4,000. I'm not sure that it's going to do that for the next 4 or 5 months, but I do think that it can go back to $4,000. I've been traveling, as you know, so I haven't been paying that much attention. Gold was at $4,000 just a few weeks ago. It could easily go back there. The reason why we don't think it will is because of all of the political and economic and financial market developments that have been occurring over the last 3 weeks, and that we expect to continue to occur over the next 4 months.
Well, here's a thought exercise, Jeff. So gold is right above the midpoint between $4,000 to $5,000. So $4,500 is the midpoint. We're now at $4,639. So the question is, do you think it's more likely that gold hits 5,000 next or 4,000 next, if you had to pick one?
I would probably say 4,000 and then 5,000. And one of the reasons I say that is around the world, we have dealers and refiners telling us that they are net buyers of gold from investors. Investors have been taking profits in the gold and silver markets over the last several weeks, which is something that, it's an issue that's cropped up several times last year, several times earlier this year. There are a lot of investors who, might say, I'm still bullish on gold. We know this from our own client base. I'm still bullish on gold and silver, but I think I'll take some profits off the table and look to reposition when the price comes back down to around $4,000.
Another theory that I've heard is that gold is positioning itself to lead inflation. In other words, this rising gold price that has occurred over the last month, that is a leading indicator for where the CPI inflation is going, and gold typically tends to do that. One of the explanations for why, this is just something I've heard, one of the explanations for why gold went up in 2025 in the first place was that it somehow sniffed out higher inflation this year. How the gold market knew about the Iran war, I don't know. But the theory is that gold sniffed out inflation ahead of actual CPI data. Does that theory make sense to you?
It does, it wasn't a matter of the U.S. and attacking Iran, but you didn't have to be a genius and you didn't have to be gold to expect higher inflation this year.
Sure.
I mean, everything that the U.S. government was doing last year had inflationary consequences, as well as other factors that were going on. There were all kinds of signs that, well, we already last year had persistent inflation above central bank target ranges. So we had inflationary pressures, and we had inflationary pressure, leading indicators of further inflationary pressures. If I said earlier that, we're right now in terms of the dollar gold relationship, we're in the second half of 1979 type of scenario. If you look at that same period of time, 1979 through 1983 or so, there used to be a leading indication of inflation indicators. And gold traded with that, not with actual inflation. So it was when investors expected inflation that they bought gold, not so much when inflation actually occurred. As the inflation actually occurred, it reinforced the investor's view that yes, they should be owning gold. But gold tends to anticipate inflation. But you don't have to be a genius to have anticipated inflation over the last 18 months.
So then are you expecting higher inflation going forward?
We're expecting inflation to stay persistently above 3%, possibly move up toward 4 or 5% on an ongoing basis, at least for the next several quarters.
Okay. In that scenario, would gold continue to rally higher? Because think
Yes.
about it. If one of the paradoxes of 2026 is that higher inflation caused by a supply shock in oil has triggered higher yields, which arguably push down gold. That's an interesting paradox. I wonder if that relationship is going to persist.
I'm not sure if that relationship's going to persist, but I do think that the combination, first off, high inflation will be positive for stimulating investment demand for gold and higher prices. The second thing is that when we start talking about higher yields and higher interest rates, we have to put it into perspective, right? So we're talking about somewhat higher interest rates. We're not talking about super high interest rates, the kind that can really kill an economy. What we are talking about are interest rates that will suck up available assets and credit and financial assets availability, and that will reduce growth, which will further exacerbate recessionary pressures and concerns about the fragility of very high equity market indices. So those factors then do loop back into higher investment demand for gold and higher gold prices.
Is there anything else that could move the gold price one way or another right now that we haven't discussed? Any other factors?
Well, I think that, one of the things that we're looking at is really political issues around the world. You have the Ukraine-Russian war going on. You have the U.S.-Israeli-Iran wars going on. Those are not going to go away anytime soon. You have a lot of domestic political disturbances in various countries around the world. And in the United States, you have an extremely unsettled political environment. Speaker of the House Mike Johnson was giving a talk to Republican leaders and leading donors to the Republican Party last month, late July. And he said, and it was, this was in public, he said it. He said, you have to understand if the Republicans lose the House and Senate, everybody in this room, virtually everybody in this room, is likely to be indicted. I mean, that's the
Wow.
level of admission of corruption and not unconstitutional actions that have been going on. And there's a tremendous unsettled view as to how the congressional elections are going to shake out. I honestly don't know how they're going to shake out. I would be surprised if the Democrats are able to take both the House and the Senate. But just in the last few weeks, you're seeing now a lot of a Republican concern about losing both the House and the
Why
Senate.
would you be
There,
surprised at that outcome?
I think that for everything that the Republicans are doing that's hurting the economy and individual Americans, the Democrats don't seem to be able to formulate an effective counter argument. I've said it over and over again for decades. The Democrats hardly seem to be a party, a political party. Yeah, and they just don't seem to be effective. If they are effective, you have a stalemated government, you have impeachment hearings, you have all sorts of things going on. The one place where that probably can get halted is the Supreme Court. You have lower level federal courts showing opposition to some of the things that the Trump administration have been doing, but it all comes down to the Supreme Court. And as Trump says, my Supreme Court justices. So that's a very big problem. So you have this tremendous unsettled view as to how the congressional election is going to shake out. And they won't be resolved in the first week of November. The Republican Party has already developed and has ready to submit challenges to the election results in all 50 states. That means that, come election day and the days after it, anything, as Mr. Trump repeatedly says, there are two election results. We either win or the elections were rigged. So you're going to have challenges that are going to keep the U.S. election, the U.S. government in abeyance, frozen in time, uncertain about where it's going to go for some period of time past the beginning of November.
So are you expecting then, Jeff, market reaction to a different congressional makeup after the midterm election? In other words, will the markets move depending on who takes the House and Senate following the midterms?
I said it in 2016 and I'll say it again. It doesn't matter who wins, we lose. Yeah, the economy loses. It doesn't really matter which way that election goes ultimately, except that it's a matter of degrees. How much economic and social and political damage will be done under the two different scenarios. But regardless of who wins the congressional elections, we're going to continue to be in a very hostile economic and political environment.
Right. But if the
And that's
Democrats
good for
do
gold.
take, but if the Democrats do take the House and the Senate, presumably certain, I guess, trade war actions, if you want to call it that, or tariff implementations would take longer to pass or would be blocked altogether. Wouldn't that be stabilizing for the markets?
It'll be destabilizing because there's this extended period of uncertainty. How do I make economic decisions? How do I make investment decisions? If I'm a corporation, how do I
Yeah.
make decisions as to whether or not to invest? If I'm a consumer, do I buy a car or a house or do I buy gold and silver?
Yeah.
There's going to be this unsettled degree of risk and uncertainty, and that limits economic growth, and
Right.
everything winds up in the courts. and you have a continued period of time of stagnant growth, inflationary pressures, and greater risks and uncertainties.
Finally, I want to talk about some other metals now. Copper has now firmly set, yeah, is now firmly sitting above its pre-summer levels, close to all-time highs.
Mhm.
Interestingly, and I think I brought this up with you before, copper and gold had at some point shared a very close correlation. That correlation somewhat broke down earlier in the summer when gold stagnated and copper started
Right.
running up on its own. I wonder if gold and silver, to an extent, is just playing catch up now. And of course, I'll stress one more time that gold and silver started moving up on the same day. So it wasn't like one started moving up,
Right.
before the other. So there were macro events that pushed both up. But the point I'm trying to make is copper has been the hot metal this summer, all year really.
Right.
Investors are flocking to copper. And I'd like you to comment on the supply demand
Yeah.
characteristics of copper right now and ultimately whether or not it's related to gold.
We updated our 10-year projections of copper supply, demand, and price, and we finished that report like in July. And Carlos informed me this morning that he's going through it again to see about changing it. Longer term, we like copper prices and copper supply demand fundamentals. However, I think that the copper price has gotten ahead of itself. And what you saw over the last 6 or 8 weeks really has been speculative buying based in part on the whole issue of AI data centers. And that then kicks back to the election because you've seen increased opposition to data centers, not just in the United States, but on a worldwide basis. And there's a big question as to the veracity, the wisdom of having all of these things built, as well as their costs in terms of water and capital and electricity and financial availability and assets in the equity and debt market. And the Republicans now are starting to realize that AI data centers are a negative for them. You're seeing them roll out all sorts of advertisements. Oh, these data centers are generating $1 billion of revenue for this state and things like that, trying to justify and convince people that they should not be negative on data centers. So I think that if you saw the Democrats really gain up the upper hand in the elections, that you could see a significant sell-off in copper prices as speculators say, oh, this is bad for data centers, and therefore it's bad for copper use in the electronic componentry that goes into those data centers and the power systems to power them.
When you say it's run ahead of itself, what are you basing that on? Is there like a fundamental value that we're looking at here?
It's hard to say what the fundamental value of copper is right now because the
Mm-hmm.
price is so much higher than the average cost of production. And
Mm-hmm.
what you really have to look at is the anticipation of future production, future supply demand balances, because that's really what the price is running on. But just as going back to your chart that you showed a second ago, if you look at it, what's the economic justification for that significant of an increase in copper prices over an 8-week period of time? It has to be
Let's take a
investment
look.
slash speculative demand. There haven't been enough fundamental changes
Hmm.
to justify that short-term spike higher in prices. I'm not saying that prices go back to where they were a year ago or 2 years ago, but I'm saying that the last 8 weeks
Hmm.
probably have been driven primarily by speculative and short-term investment demand.
By the way, can that same argument be applied to gold and silver in the last, not 8 weeks, but the last 3 weeks? Was this rally driven by speculative and investment demand? Whereas the
Absolutely.
fund, yeah.
Absolutely.
So the fundamentals for gold and silver haven't really changed that much since maybe mid July, would you say?
I'm Yeah, I mean, we're looking at our 10-year projections for gold and silver this week as well. And I'm actually concerned because of, as I said, if you look at where we were projecting for fundamentals, including investment demand for gold and silver, even 3 months ago, and you talk to people in the physical gold and silver markets worldwide, they're seeing investors buy less metal than we had anticipated and sell more metal than we had anticipated. So the gold and silver fundamentals may be weaker than everybody, including CPM Group, had been expecting just a few weeks ago.
Okay. Is there anything in the metals complex, or actually not metals complex, but the commodities complex overall, that you don't think is overbought or running ahead of itself at the moment?
Not off the top of my head, I can't really think of anything.
Well, that presents a challenge for investors in commodities. Is it not? If one were to get in now and pick something, the decision-making framework is usually what is the least overbought thing right now.
Right.
And if everything seems to be elevated, how do we choose?
Exactly. And it's the same logic that applies to the dollar. The dollar is the least worst place currency to put your money in right now. And the least worst commodity probably is gold.
Excellent. Finally, on energy, I know oil is dependent on the situation in the Strait of Hormuz, but that aside, are the fundamentals for oil and gas to the downside or upside? In other words, at $83, $85 on the WTI, are you expecting downside pressure or more upside pressure?
I'm expecting shorter term, more upside pressure, and then longer term sideways to lower pressure. I think that, prices around $86 a barrel are slightly elevated over what I might consider a market clearing price. But part of it's going to depend on what happens on a global economic basis. If we avoid a recession and we see continued economic growth greater than 1.5% in the industrialized world, then I think that $86 is probably pretty close to a market clearing price. If we see sub 1.5% real GDP growth in the industrialized world, then I think that you're probably talking about $70 or $75 a barrel as being a market clearing price.
Okay, excellent. Thank you. Jeff, tell us where we can find you, follow your work.
I'm not going to tell anybody where they can find me. No, but you can find our work at cpmgroup.com. No, it's www.cpmgroup.com is our website, and you can read we have a lot of free stuff there, but you can also read about our yearbooks, our monthly precious metals and base metals advisory, and the full range of consulting services that we have. We also do twice weekly YouTube videos that we post on YouTube. We haven't done them for the last 3 weeks because I've been traveling in Asia, a combination of work and vacation. But unfortunately for me, I'm back in New York and sitting at my desk. So we'll be starting up our videos again on Friday.
Well, fortunately for us, we'll have more content to watch. So welcome back to the U.S., and I hope you enjoyed your trip. Thank you for your analysis today.
Thank you for having me.
Thank you for watching. Please do like and subscribe. Follow Jeff in the CPM Group. Links down below.